Hey, so most first-time buyer videos give you a checklist. And look, a checklist is great if everything on the list is already in good shape. But what happens when your credit needs work, or your debt is too high, or you just don't have the down payment yet, right? That's not a checklist problem. That's a plan problem. In this video, I'm going to walk you through how to actually build that plan so you can get from where you are right now all the way to sitting at the closing table. We're going to cover 4 areas today. Each one, the goal isn't just awareness, it's knowing your next move, right? So the first one we're going to talk about is credit, what lenders need to see and how to get there. Debt, what to pay down and when. Income and paperwork, how to get organized before you're asked for it. The down payment, where the money can come from, and how to plan for it. So before anybody else looks at your credit, you should look at it first. Go to annualcreditreport.com. This is a free Federal Trade Commission approved site where you can go pull your own report once per year from each of the 3 bureaus. That's Equifax, Experian, and TransUnion. Again, this is a free site. There's no sign up, and it's safe and secure, and there's no excuse. Okay, go look, check your credit, make sure that you see everything on there that's supposed to be on there, and if there's something that's not supposed to be on there, you need to deal with it. So here's what a lender wants to see when they pull your credit, right? 5 accounts. That can be active or closed, and they're looking for about 5-year history. Also, a mix of credit, so revolving, installment, different kinds of debt. The whole point is that you're asking a lender to give you thousands, if not hundreds of thousands, if not millions of dollars, right? And yes, it's tied to the house, but it doesn't necessarily mean that they're just going to give it to you if you cannot show that you have been able to handle debt before now, right? So I like to say that a credit report is kind of like a Yelp or Google review of you and how you deal with your finances, right? If you've only got a 3 or 4 review on a restaurant, you go and you're going to go out to dinner and you're going to try a new restaurant. You check the reviews and you only see 2 or 3 reviews and one's bad. That's not going to give you a good feeling of having a good time at this restaurant, right? So same thing with credit. If a lender's going to give you a big loan and they look at your credit and you only have 2 accounts and one's bad, they're not going to like that. So this is where you want to do your background, and your due diligence. You want to go ahead and look at your credit. If there's any collections or charge-offs, you want to get those cleared. Here's a specific tip for those. If you have any, call the companies. The information is on the credit report of how to contact them. Negotiate, if you can, a lower payoff. But when you do get those things cleared, you want to get the proof in writing. And here's why. Collection agencies are notorious for taking your money and clearing the debt, but not updating your credit report, which is a very important thing. So it is very possible for you to go ahead and get this done. Your collection is now paid, but you want to keep that in writing forever because if it comes up, you have the proof. Okay? So what affects your score these days that a lot of people don't realize is the credit utilization. So that's how much you've used of the credit that you have. So for instance, if you have a credit card and you have a $10,000 limit, well, if you've used $9,000 of the $10,000, then you've got a high credit utilization. That's 90%, right? So that's going to drop your score. And of course, you're trying to get a loan. You want to boost your score. So once you go over 50% of the limit of the card, it's going to drop your score. You want to try and get those down to 30% or less. Ideally, you want to get to 10% or zero, right? One way to do that, of course, is to pay the debt down. Not everybody just has the money lying around, so the other way to try and tackle that is by calling your credit cards and raising the limits, right? Don't use it, just raise it. So you go from the $9,000 balance, if you raised your limit from 10 to 15, now you've got a lot much smaller utilization. If you do have a low score, doesn't mean that it's a dead deal. It just means this is your starting point. And the whole point of the video is to find out where you are at, fix the problem, and then continue to go, right? So that's part of it. We can build a plan around a low score. So the process looks like this: identify, fix, and qualify. So identify what's dragging your score down, fix the items that need fixing, whether that's paying off debt, raising a limit, or paying off a collection, etc., and then updating your score. Updating the score can be quicker than you think. Most people think that they have to wait the 2 to 4 weeks for your report to naturally change. That's by the credit agency, your creditors, your credit card accounts, reporting the information to the credit agency. But there is what's known as a rapid rescore, and that's where somebody would pay off debt and show proof, and then we send that in, and then a couple days later they update the report and your score increases. So I had this happen to a client recently. She was not qualifying because her score was too low, but that was only because she had some debts. We had her pay off the debts. She showed then the proof. We sent that in. A couple days later, the score increased and she was able to close. Now, when you want to pay off some debt to qualify, the ideal situation is where you would go ahead and pay that off before you apply. So anytime that you're moving money around or paying off debts, you have to assume that you need to show where that money trail came from, where it came from and where it went. So paying it off before gives your score time to reflect the improvement and locks in a cleaner debt to income ratio. Paying it during the process can shift your numbers mid-application and cause complications. You also have to then jump through the hoops of showing where the money came from. It's not a deal killer, it's just you want to stack the deck in your favor, okay? Now, additionally, you don't want to increase your debt load during the loan process. You want to make sure that if you have any car purchases coming up, big purchases like buying a car or going on vacation or something like that, buying furniture, do that all after you buy the home and move in, okay? Unfortunately, not everybody thinks of that, but that is very important to know ahead of time. Close on the house first, then buy the car. In addition to that, don't change anything, especially your income. So don't change jobs or retire during the process. Even a move to a higher paying job can reset how your income gets documented and delay your timeline. So lenders want to see stable, consistent income. Any disruption raises questions. All right. So secondly, get your paperwork organized before anyone asks for it. So here's what you're going to need. Assume that you'll need the consecutive pay stubs to cover a full month. So typically that's 2, but I would even encourage you to gather more, 6 weeks to 8 weeks of pay stubs consistently. You want to get 2 full months bank statements and asset statements. So IRAs, investments, CDs, bank accounts, checking, savings, etc. And then that's all pages, of course, for 2 months consecutive. 2 years tax returns, 2 years of W-2s and 1099s. And then make sure that your ID is not going to expire soon. If it's going to expire in the next few weeks to few months, go ahead and get it renewed now. There is absolutely no reason to wait. Just get it done. it can mess up the process. Okay. The last thing is lenders and the application process and disclosure process for any kind of lending is going to be very digital. So if you are not tech savvy, then you may want to ask a family member or a friend who is to help, because your lender is going to have an online application, online disclosures. Everything is typically emailed these days or sent to a secure link. And so digital copies of everything is going to be a lot smoother of a process for you. Okay. So as a general rule, lenders look back 2 months on bank statements. That's the window. Any large deposits that show up in that window need to be traced and sourced. Go into it with that understanding. It's going to make the process easier for you. So ideally, know where that money came from. If you have a large deposit, where did it come from? The lender is going to want to know. And they want to show that it's your money, right? So be ready to document it. Any cash deposits typically are not allowed for qualifying. And so if you have cash that you're going to use, go ahead and put it in the bank now. Don't wait. Put it in the bank now, get your name on it, and then let that sit there for the 2 months so that you won't have any troubles and you can use it without a problem, right? And this applies for most real estate loans. There are some mobile home loans that are more lenient in that way, but just check with your lender first, and if there's any plan that you need to come up with depositing your funds or moving money around, tracing it and showing the paper trail, definitely go ahead and talk to them about it. Now, where does your down payment usually come from? Obviously, your savings, but also can be coming from a gift from family or friends, typically is allowed. You will have to properly document where it came from and have a gift letter signed usually. But you can also liquidate assets, meaning investments, bonds, other like CDs, or even selling a car, boat, or RV. Just be careful of any kind of tax consequence. There could be capital gains or other rules that you need to follow when you sell big chunks, big things that result in a chunk of money. So talk to your tax advisor first. That's always a good idea. And then if you're going to borrow from a 401k or other retirement, again, talk to an advisor. There might be penalties and fees for that. So just do your homework first. It's always good to know ahead of time rather than falling in love with a home and then having to rush to figure all this out. So the next thing is going to be knowing what it is you're comfortable paying. Not just down payment, but also your monthly budget. It's good to figure that out ahead of time, especially if you have a partner. You don't want to go look at a home and maybe fall in love with it and then figure out, oops, we don't even know what we can afford or what we want to afford. I've had a lot of clients who can afford a lot more than they want to afford, and others that want to afford more than they can. So you want to check that out ahead of time. Getting pre-qualified is a great idea. I've also seen a lot of people who are then looking at these homes, knowing what they qualify for, but not really sure of what it is that they want. How many bedrooms, location, all of that matters. Parking, etc. Kind of maybe do a list of your needs versus your wants. That might really help when you're looking at homes. So here's the main thing I want you to take away from this. Not that the video is over, but your credit, your debt, your savings, your income, it doesn't matter where you are right now, as long as you're doing the work to check it, fix it, and be ready to buy. Most of the people that I talk to are not exactly ready to buy today. They need to do some work ahead of time. But that's the whole point of talking to a lender first, or a real estate agent, or an insurance agent, and check where you're at, fix it, and then close. And that's why I came up with my MAP framework, which is my mortgage action plan. So it's not just a checklist, it's actually a map, a plan of how to get from where you're at to where you want to be. So if you'd like to talk to me about it, feel free to book a call with me. Just go to my website, you'll see the book a call function there. And I help people in California on condos, houses, and mobile homes. I have been lending all of those for 30 years, mobile homes specifically for 20. And I'd love to help you. Thanks.